Welcome back to the channel, everyone. I thought I'd give an update on SoFi or IPOE. As I said in the previous video, I've been looking into the company a bit more, but more importantly, tried to come up with a target price or intrinsic value based off of the expected future growth. So I've taken their expected financials that they gave us and we covered in the previous video, and also applied some growth rates beyond that point for 2026 to 2030. We'll get to how I calculated those in a moment, but I want to give you the fair value now, or the intrinsic value now, and then we can retrace the steps on how we got there. So as you can see, what I've got is based off of the assumptions I made above, or the growth rates. We've got an intrinsic value for the merged company, or let's call it SoFi, of 35 billion today. And then that translates into a fair value for IPOE stock and the ownership or percentage ownership it represents of 3.3 billion, which then again translates to a share price of $33 per share for IPOE. All right, and this is about a 6x return from the current price if you were to buy and hold the company, for the whole period. And basically that's because the market cap for SoFi at the moment is around 24 to 25 billion. Or an enterprise value of 22. That's based off of the market cap for IPOE, and again divided by the amount of ownership that IPOE represents in the merged company, and a share price of $22 per share. So as you can see, based off of my valuation model, it is quite significantly undervalued, but it all boils down to if they can achieve these metrics up here, or these financials up here. There are a few flaws in this DCF which I would just like to point out now. First of all is net income. Up here, net income is being used as our stream of cash flows in the intrinsic value calculation, as we didn't have valid data on capex requirements or cash flow, to be honest with you. This could work out conservative or bullish, but to be honest, it's a flaw, as the free cash flow is always the more accurate number to use. Also, we're having to convert the SPAC value back into a merged company value, so it will have some discrepancies, I'm sure. However, it's likely they are small. For example, the current market cap of the merged company, like I said, around 24 billion, but the way in which we're calculating that isn't based off of shares outstanding and a share price of the merged company. It is by dividing the percentage of ownership that IPOE represents. So there will be a couple of discrepancies, I'm sure. So right, now we've covered that, let's look at what assumptions have got us to this 35 billion intrinsic value, or 3 billion, 3.3 for IPOE. So we've got revenue growth in the first 5 years of 43%. And this is what we covered in the first video. This is their expected revenue growth that they've given us, that they should be able to see in the next 5 years. And then following that, I've gone for a 5 to 10 year growth rate of 28%. And this is trailing down slightly, but for a company that's going to be growing at 43% compounded over 5 years, that growth isn't just going to fall off of a cliff, and the runway for growth will continue, in my opinion, especially with it being a fintech company, and its revenues are relatively small at the moment. As you can see, it only gets us to 12.6 billion in 2030, which actually, if anything, looks like quite a small number considering the total addressable market that SoFi has. Going down a bit, if we look at EBITDA, so for EBITDA, I've got a 35% EBITDA margin in 2030. Now, they told us they expect 32% by 2025, but as we saw with the nature of the company, they get more efficient with scale because of the vertical integration element, that the company has. So there should be an expectation that margins will improve even just by a small amount. This also isn't factoring in the possibility of them receiving a bank charter, which they've said quite clearly will improve their margins due to being less capital intensive when underwriting loans and things like that. So more for their lending part of the business. So there's an element of conservativeness here, which is good. Net income, I'm assuming, is just around 65% of the EBITDA figure, as followed a similar pattern previously, and they expect net income margins will get to around 20% by 2025. And I'm just saying that those margins will improve slightly, just as EBITDA does, as they begin to improve efficiencies with scale, and each customer becomes more profitable to them. Cash and debt, well, I've got cash growing at an unmeaningful rate of about 5% over the period. I can't see any debt on their balance sheet and in their SEC filing. So, if you did find any debt, or anyone knows any debt in their name, then do let me know, because I was quite surprised. But it's brilliant. You love to see a company with no debt, for sure. And then no shares outstanding for the merged company. Like I said, we're going to have to be converting back into IPOE to be able to get a share price, which we will do. And I will say, based off of the current market cap, I mean, it's even gone up quite a fair bit after, or 20% since we last spoke about it in the previous video and the analysis. So, you know, a lot more than Chamath paid for it, I must say, and we do have to remember that. Valuation is getting quite rich, but, you know, it's a compelling company, and these numbers do look fantastic, so maybe it's well deserved. Now, if we move on to my terminal values, I'm using two methods for my terminal value, two market multiples. So for EV to sales, I've got a 12 times multiple, and that's given me a terminal value of 152 billion in 2030. And you might think 12 times sales look big. I know we talked about 19 times in the initial video, but again, that was for 2025. I do think the premium will come down. And actually, when compared to some of its peers in the fintech industry, it's a very conservative multiple. You got PayPal and Square around 14 times, but with, you know, not as good profit margins, and you've got MasterCard and Visa obviously have a much steeper price to sales multiple just because of how high their EBITDA margins are. So, you know, you can see the pattern work there, but I think 12 is a conservative estimate, and it still works out that IPOE or SoFi seems undervalued. So there's no point pushing that multiple up to something that could be unrealistic into the future, in my opinion. I think it's good to stick with 12 and a slightly conservative estimate if we can. For my EV to EBITDA multiple, I've got 133 billion. That's based off a 30 times EBITDA multiple. And again, if I show you the list of comparable companies, it's a conservative number, considering that, you know, they're going to be having the highest growth rate of all of the companies, it's most likely during this period, or definitely, you know, higher growth rate than what these other companies are experiencing now. And they're going to have EV to EBITDA multiple that sits, you know, around the bottom compared to all of these companies. So it is the fintech industry. Like I said, they do have high multiples, and it's mainly to do with the total addressable market, mainly to do with the nature of the business. In some cases, it is justified. So just wanted to show you that because, of course, on the face of it, it could look like they were steep multiples, or someone might think that, but actually I want to show you how conservative they are. And I've averaged the two of these market multiples to come up with 145 billion. I just split it down the middle. I can't say which one would probably be more accurate. There's too many variables to go into it. And if we compare this with the likes of Square, PayPal, MasterCard, Visa, etc., we can see that it's not a standout valuation or not a standout market cap, especially given there's a 10-year gap here. You know, a lot of the, or those four companies I just mentioned will likely be worth more than this in 10 years' time. And like I said at the beginning, that 145 billion market cap is roughly 6 times from the current price, which is a huge return, right? Brilliant return to get. And my intrinsic value for the stock or merged company, sorry, is based off of a 15% discount rate, which I usually apply. But in this case, I think it's a fair rate, represents the risk involved, in my opinion, you know, because of the SPAC element and general, you know, uncertainty, but also we are projecting quite far out into the future here, you know, to 2030. So the bigger the discount rate, the higher the margin of safety with stuff like this. So, and also speaking of margin of safety, I've got a margin of safety price for the merged company, knocking 25% off of that intrinsic value. And it's still undervalued even based off of that. So maybe that's a good sign. Now, if we look at IPOE stock, at the moment, we've currently got, similar to this, 49% upside based on where we are now and what the fair value could be for that stock and what it represents in the merged company. If we wanted to apply, you know, a margin of safety to that, a bigger margin of safety, which would represent somewhere near a 21 or 22% discount rate, I think, then that gives us a share price, or sorry, not a share price, but a market cap of around 2.5 billion for IPOE, which is a share price near $25 per share, as you can see here. So, you know, we're under that at the moment, but I think, you know, people are waking up to the fact that SoFi probably has a big future ahead of it, or most definitely has a big future ahead of it. The financials make sense. I think when this thing, you know, first got announced, I mean, the valuation was very, very cheap looking back at it. I mean, brilliant valuation, to be honest with you. You wouldn't have seen much IPOs available in this sort of space or in any sort of tech company with those sort of valuations. So well done to Chamath. He's definitely got a good deal on his hands, and, you know, it is something that I plan to hold and keep an eye on for a while. And I'll do a little bit more work on the company, keep tabs on it, and I may even be buying more in the near future, but I will let you guys know. Again, there are risks and uncertainties involved with this one, so just play with some caution, do your own research, determine whether you should be buying or not. So there you go. Wanted to make it quick and just show you my valuation model for the merged company, or SoFi, we may as well call it now. And again, there are risks and uncertainties involved in this one. So, you know, just play with some caution, do your own research, determine whether you should be buying or not. I will be doing some other companies, or there are some other companies on the list. I've got a long list of companies that I need to get some videos out on. You know, I've already started some research and analysis on some of them. So it's just a case of finalising that and filming them. So they will be coming out very shortly following this as well. I just wanted to get this out to you quickly, and I'll leave, you know, a link to the sheet in the description so you can have a play around with it yourself. And also, you know, make any changes if you think they can underachieve or overachieve these assumptions up here. But until next time, good luck with your investments.